it opens up a whole new world around your investing, around enhancing your dividends, and protecting yourself for when the market goes down. Today, understanding call options. This is right back to the beginning of your first lesson, and it's our introductory series. Remember, we've got 30 lessons coming up for you to take you from zero to hero in the options market. Going to teach you how to trade and everything from call options to put options, knowing the difference. From volatility, learning what implied volatility is against realized volatility. We're going to teach you all about margins and your BPR, so your buying power reduction. We're going to take you through all the Greeks. Okay, sounds like a bit of a foreign language, but we're going to teach you this whole course, taking you to be comfortable and confident in taking positions, buying options, but also selling options as well. So, step by step, empowering you to become a successful retail options trader. We're going to take looks at examples in the real world. We're going to use the platform and show you exactly where to find everything on the Tasty platform. Right, so we're going to look at expiration and the strike price. Okay, so the time that your options contract is for is looking towards the expiration, right? That can be a certain month or even 9 p.m. tonight, all right, on the 0 days to expiry. DTE is always days to expiry. So that is the expiration. Each options contract has a set expiration time. It also has a strike price. So at the moment, if I was looking at the S&P 500 having a rally, I might want to look at the Spider 500, 570 calls. That is the strike price. So I say the expiry, right? The April 570 calls. So expiry, strike price, and then if it's a call or a put. Options in the US represent 100 shares of stock. So if you sell a contract for $1, that equates to $100 in real value, right? So you always take the $1, the price of the option, you multiply it by 100, and that gives you this real notional value. Obviously, 50-cent contract equals $50. Now, there's 4 basic options trades: a long call, a short call, a long put, and a short put. Right, so that is the 4 basic options trade we're going to take you through. Buying a call most closely represents purchasing shares, right, that in a normal investor way that you do. So buying a call is the one that resembles buying shares. That obviously offers the benefits of stock price going up and unlimited profit potential. Purchasing a call involves paying a debit, right? You've got to pay an entry fee into the trade to acquire the contract. Profitability depends on the stock price rising above the strike price in addition to the premium paid. Okay, so if the stock's trading down here, your strike price is here, then the underlying has to go up to your strike price. But for you to become profitable, it also has to go up and above the premium that you paid, i.e. the entry price in. The maximum loss in a call option trade is limited to the initial premium paid, right? So if I pay $1 for that entry ticket, then my loss is limited to that $1 times 100 or $100. The potential profit's unlimited because a stock can continue going up, right? If you thought a stock was going to get taken over like Walgreens did recently, and you can buy in for a small amount, then that potential profit's unlimited. There's no ceiling on how high a stock can climb. Now, here is your first look at the platform. right? And those important 3 circles there are where you find, when you get the deal ticket up, the maximum profit, the maximum loss, and the price of the option as well. So the debit is the one at the bottom, right? That is the price you're paying for the option. So that debit would be 89 cents per share in this example. So that is $89 you would pay. Therefore, your maximum loss is $89, right? Maximum profit, as we said, is unlimited. Now that's going to change around when we show you how to sell a call option. Selling a call is, of course, the opposite of buying. You receive money, okay? Somebody else is buying the option from you, therefore they hand you over $89, right? So you become the market maker in that respect. You receive a credit, and that is equal to the initial premium. Of course, it's 88 on this one, because you sell on the bid, or you sell in the mid, right, the mid price. So the credit is equal to the max profit. So that max profit there is, of course, the credit. All you can do is keep hold of the credit you've received, right? It doesn't get any bigger. You can profit by that $88. The maximum loss is unlimited, because, of course, the stock can go against you and go up. There's the graphs you have to get used to, right? So it's as soon as you understand which way is the horizontal, the way that you're going, then the stock price is going higher the further to the right you go. So if you think about it, on the left-hand side there is 0, and on the right-hand side is 100, or 200, then that's your stock price. So the long call, the big green C, is where you are buying. That's the strike price. Now, because of that big green triangle on the long call and the big red triangle on the short call, it may seem like buying calls is much better than selling calls, because the profit is capped for selling those calls. However, what you can't see in the images is that there's lots of other factors at play. And we'll discuss those later, such as volatility, theta, which is your time decay, right? So you've got vol. These are where these Greeks start to come in. Volatility, theta, extrinsic value, DTE, days to expiry, and directionality, that may make certain option strategies better under certain conditions. Now, every one of those things, the factors that come into play there, we've got an individual lesson dedicated to those things coming up in the series. So you are going to learn about all of this. We're going to do the same one on puts, but there is a class dedicated to implied volatility. In fact, there's 2 dedicated to IV. There's going to be a class dedicated to theta. There's one dedicated to extrinsic versus intrinsic value, and then, of course, directionality. So we cover all of this in the upcoming lessons. Your takeaways today are: buying a call option allows you to buy 100 shares of stock at the strike price that you choose. Selling a call option enables you to bet against the movement of a stock, but exposes you to undefined risk to the upside and the obligation to short 100 shares if the stock price is above your strike at expiration. At that expiration, long call holders are profitable if the stock has moved up past the strike price, plus the premium paid, plus your entry price, that is, into the position. At expiration, short call holders are profitable if the stock price is below their strike price or above the strike price by less than the credit received. Now, an example in the real world at the moment, I am long 200 shares of Nvidia, right? I bought them at about 112, but the calls were trading at $3 a share. The 115 calls, $115 calls. So I want Nvidia to go from 112 to 115, right? And essentially, I've made an agreement that I will sell my shares at 115. But somebody has paid me $3 to entice me into that arrangement, right? So if Nvidia goes to $118, essentially I've sold the stock there, because it goes from 112 to 115, so that I make $3 on that stock. I then sell my shares at 115, but I receive the $3 of credit for agreeing to sell them. So I've essentially sold them. My total profit is buying the stock at 112 and I'm selling it at 180. So that is, one of these great examples of where if you sell a call and you actually own the stock, then you're benefiting not only from the stock going up, but also the credit. Now, if the stock doesn't go up and Nvidia drops to 109, then I still own the stock at 109, but somebody's paid me $3. So I've actually not lost any money because I've sold that call. So selling options is this wonderful world where you can either extend your profits or you can reduce your losses, reduce your entry price. Because if I sell that 115 call, my new in price is really 109 because it's 112 minus that $3. So it's one or the other. You can't have both, obviously, but it is one or the other. So thank you very much for going back over this introductory class. We've got between 30 and 35 classes in total. And, I'm really excited to take you guys towards this understanding of options. So it opens up a whole new world around your investing, around enhancing your dividends, and protecting yourself for when the market goes down as well. Thank you for joining me.